Is the Federal Reserve going to lower interest rates in 2024? Well, the market is certainly expecting so, as gold is currently inching higher towards its record in a bet for the Fed to pivot, as the price of gold is just toying with its all-time highs. We are also seeing bond yields continue to fall, with a bet that the Fed has found a sweet spot, with most of the decline in yields coming at the long end of the curve, but even some modest declines in yields at the short end. The president of the Cleveland Federal Reserve, Mester, said that the current interest rate lets the Federal Reserve be nimble with incoming data, making light of the fact that the inflation rate is still above their goal of 2%. We've also seen an end of the year rally here in the stock market as bets of a future Fed cut increase. And billionaire investor Bill Ackman is currently betting that the Federal Reserve will cut rates even sooner than the market expects. But it's not all one-sided. There's a very good argument and much data to point at that says that the Federal Reserve will not be so fast to cut rates. Direct from the source, the Fed's Barkin says that rate hikes are still on the table if inflation doesn't continue to drop. And that's rate hikes. That's not even keeping rates the same. It appears there are many diverging views on rate hikes or rate cuts within the Fed right now, including Susan Collins, the president of the Federal Reserve Bank of Boston, saying that more Fed rate hikes are still on the table. This aligns with the more recent history of the Federal Reserve's statements about rates staying higher for longer. As with most things, the truth here is going to require a bit of nuance. We have to take a look at the difference between real rates and nominal rates. We all understand that if inflation is 5% and interest rates are 5%, then the real rate of interest, when adjusted for that inflation, is 0%. Because you could put your money in a savings account, let's say you put $100 in, and at the end of the year, you get $105 back. But the amount of stuff that you could buy stays the same. Anything that used to cost $100 now costs $105. So in real terms, you didn't gain anything. So the real rate of interest was 0. Well, the same exact thing happens when prices are falling, which means if from today to a year from now, something that used to cost $100 now costs $95, then the inflation rate is -5%, or it's a deflation rate of 5%. That means that even if interest rates were 0% during that time, the real rate of interest would actually be 5%. Because if you put your money in a bank account and it stays $100 that whole time, but the amount of stuff that you can buy increases because all the stuff that used to cost $105 now costs $100, then you actually gained purchasing power at a rate of 5%. The Fed has been very clear about this in the past, that if the rate of inflation falls, and especially if we tip over into deflation, then they would have to lower the nominal interest rate, nominal being the actual stated number, in order to maintain the same level of tightness. Because if they keep interest rates where they're at, but prices start to fall, then in reality, rates are increasing when adjusted for that inflation or that deflation. So currently, as of the time of this recording, the official rate of inflation, which is what they look at to base their decisions on, is around 3%. Let's just round down to 3%. And interest rates, let's round to 5%. This would mean you have a real interest rate of positive 2%. But if inflation falls to 0%, meaning prices stop going up or down and they just stay the same, well then you would need to cut rates from 5% down to 2% just to maintain the same real level of interest rates. Now, if this seems like a ton of unnecessary manipulation, it absolutely is. If we had a free market in money, this would all be taken care of automatically by market dynamics, because the price of anything is always determined by the supply and the demand for that item. If the supply of pizza 100x over the next month, there would be an overabundance of pizza and everybody would be wanting to get rid of it. You'd probably be able to get a month or 2 months or 3 months supply of pizza for free just because there was so much of a supply of it. Similarly, if something happened that caused all the pizza in the world to vanish overnight except for maybe a couple of pizzas, well, the demand would far outpace the supply then, and there would be a big auction for those remaining pizzas, and they would probably go for hundreds of millions of dollars. The same exact thing happens with money. Imagine a situation in which every individual in an economy has built up a large supply of savings. Well, then every single person is competing competing to be a lender, competing to be an investor, and has a bunch of money to spend. That means anybody who wants to borrow money can look for the most attractive rate. Since interest rates are the cost of money, this would drive interest rates down because anybody who wanted to borrow would be able to go to any of the lenders and pick whoever had the lowest rate. So in an environment like this where the money is determined by free market dynamics, if the savings pool is large, everybody has a ton of savings, it drives the interest rate down. What does that incentivize? Well, that incentivizes borrowing, because if I can borrow at a low interest rate, then there's a good chance that I can take that money and invest it and make a positive return. It also incentivizes spending. So when the savings pool is abundant, it is large, it incentivizes investing and borrowing and spending. But the longer that goes on, the more the savings pool dwindles and people run out of their stock of savings. So the supply of money available decreases. Now in this environment, because there's less money floating around, everybody needs to borrow. And there's very few people with savings left to lend, which drives the interest rate up because now the lenders can be the ones to set the price and allow the borrowers to compete against themselves. The high interest rate environment then incentivizes being a lender, which also incentivizes savings so that you can become a lender. Because the cost of servicing that debt goes up, it makes investing hard and incentivizes saving, incentivizes lowering consumption, and the incentives swing back the other way to rebuild that pool of savings. For the next moment, I'd like to share with you about a very important company who is sponsoring today's video, Monetary Metals. The reason why Monetary Metals is doing something so revolutionary goes all the way back to when FDR outlawed gold ownership with Executive Order 6102. What a lot of people don't know about this gold confiscation was that it also outlawed the gold clause that was very common in debt contracts, which allowed people to get their debt paid back to them in gold if they chose. Fast forward from there to 1971, when the US left the gold standard for good, there's no longer any reason to keep this law in place. But what even fewer people are aware of is that this law was actually repealed, which meant that it became legal to denominate debt contracts in gold yet again. Now, for the longest time, I was not aware that this was legal in the United States, let alone that there was any company out there actually doing it. However, when I discovered Monetary Metals, I realized this is exactly what they're doing and nobody else is. They have created a way for you to get on your own personal gold standard by paying you a yield that is denominated in gold, it's priced in gold, and it is paid in gold. They have multiple offerings like leases that pay between 2 and 5% and bonds that have paid up to 19%. Now, just to be clear, this means that if you start off with 100 ounces of gold at 4%, then you end the year with 104 ounces of gold. The yield is denominated and paid in gold, regardless of what the price of gold does. Your gold is actually growing. Now, I have spent quite a bit of time over the last 2 years now researching how this company does what they do. I've gotten to know the team, and as a result, I've not only become a customer of the company myself, I use the products, but I've also invested into the company personally. Monetary Metals is doing something truly unique, revolutionary, by paying you a yield on your gold, priced in gold, and paid in gold. And I highly recommend and encourage you to click on the link in the description below and open up an account today. So in a completely free market in money, the dynamics that are built in cause equilibrium. You do have swings of money becoming more abundant and less abundant, and swings of interest rates going up and down, but it is a self-correcting system all on its own. But instead of that, we get everything manipulated from the top down from a few ivory tower elites. They have to pull on levers, financial levers of their own creation in order to fix the problems of their own creation. It sure is a good way to ensure job security by being both the firefighter and the arsonist. First, create the inflation, and then cause the recession that fixes the inflation. Everybody's happy, right? So likely, as a result of the inflation rate falling, as a result of the coming recession, which that's what happens during a recession is prices tend to fall as GDP contracts, the Federal Reserve will probably lower rates in response to the rate of inflation falling, just in order to keep real interest rates at the same level. But it is also very true that the market will almost certainly not perceive perceive those interest rate cuts as maintaining a tight monetary policy stance. It's very unlikely that the market will look at the Fed cutting interest rates and say, oh, that's just the Fed maintaining a restrictive monetary policy. The more likely outcome is that the market looks at this as a complete pivot and an easier monetary policy. And that perception alone can cause the results of an easier monetary policy by the incentives being skewed by people going out and spending and borrowing as if interest rates in real terms were lower, which means the likely outcome of that will actually be more inflation. But first, the likely outcome is a recession, as we can see what happens when the Fed lowers interest rates. This is a chart of the federal funds rate. This is the interest rate that the Fed actually controls, and this chart goes all the way back to 1955. These gray bars are recessions, and you can see that every single time a recession has happened since 1955, it is associated with a time period where the interest rate is going down. There's this one period from 1966 through 1967 when the Fed lowered interest rates and it did not result in a recession. And this second period in 1984 through 1985 when the Fed lowered interest rates and it did not result in a recession. But apart from that, every other time the Fed lowered interest rates, it was either in the middle of a recession or immediately preceding a recession. And it's very unlikely that this time will be any different. I show you this as a warning because most people are going to be completely fooled by this and see the rate cut as the sign of the times changing, as easier times that'll be reminded them of 2020 and 2021 when money was flowing and everything was great. People are going to think that's going to start happening again, and it's not. The Fed lowers interest rates into recessions, not on the way out. And if you want to be able to protect your wealth and profit from the coming storm, you need to join Heresy Financial University because you'll learn how to do exactly that. Link is below. The other result of this is going to be easier government financing. Currently, the chart of the interest payments alone on the federal government's debt looks like the chart of a penny stock or a meme stock or some altcoin, which just shows how unstable and how unbearable the financial burden of the debt is becoming for the US government. But any sort of a reduction in interest rates will translate over into extending that period of time that the government can continue to load up on more and more debt. And obviously that will translate into more government borrowing and more government spending, which again means more inflation. Ultimately, if the Federal Reserve lowers interest rates even to maintain the same level of real rates, restrictive monetary policy, the long-term effect will be higher inflation for longer. Just like in the 1970s, there were a few times when they lowered interest rates, then inflation reignited and they had to raise them yet again. In fact, this cycle played out 3 times before they finally beat inflation. We are in a new long-term cycle. For 40 years, from 1940 through 1980, we had interest rates and inflation moving higher. And then for the next 40 years, from 1980 through 2020, we had inflation and interest rates both moving lower. Interest rates hit 0% in 2020 and can't go lower than that. And that's when we embarked on the new phase of the long-term debt cycle with interest rates and inflation moving higher yet again for the long term. So if you're looking at the long term here, we are absolutely in for a period of higher rates and higher inflation. There's no way around it other than a swift, devastating, deflationary death spiral. But in the short term, we will absolutely see dips again like we did in the 70s. Now, most people have spent the last couple of years riding these waves completely backwards, buying meme stocks at the top of the bubble in 2021, right before everything crashed. And then of course, once these stocks were near their bottoms, everybody sold. Most of those same people now have thrown in the towel saying, oh, active investing is impossible. It's impossible to time the market correctly. Even 50% of the time, you can only time it incorrectly 100% of the time. So they're throwing in the towel, going into a standard 60-40 portfolio thinking, oh, the last 20, 30 years of market data is the thing that I need to rely on. When in fact, we've been in a 40-year cycle that has now ended, and we are in a new phase of the cycle that will very likely look a lot more similar to the phase of the cycle that preceded the last 40 years. Rising interest rates and rising inflation. The rules of investing are different over the long term in these time periods. Now, I get it. Nobody wants to be a sucker buying high and selling low. What everybody actually wants is to just make an above average return investing and not be vulnerable to large crashes. And that's why you need to become a member of Heresy Financial University, because you'll learn how to grow your portfolio consistently and safely over time. I'm introducing new training material all the time to help make you a better investor and make you more money. And because of that, the price is going up in January. So make sure you become a member of Heresy Financial University before the end of the year, because then you'll be grandfathered into the current pricing, locked in forever. Link is in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.